Hey everybody, this is Jose Blasco. This is a sound check. We are about to get started. Please send a quick message on the chat box with a quick hello. That way I would know you hear me and we are ready to get started. I believe all should be good, but again, always good to have this confirmation before we get started, so I know all is under control technology-wise. Let's do that, guys. 20 seconds to go and we begin our session, everybody. Let me put myself in the bottom right side of the corner, as I always do. Here we go. How are you, everyone? Good to see you. Thank you so much for that confirmation, Christian. This is appreciated. Thank you so much, everyone out there on the other channels as well. And here we go, Joanne. How are you? We just hit the top of the hour. So, my friends, this is Options with Options. My name is Jose Blasco. This is Aug-5, 2021. We're going to be trading options today, isn't it? Beauty of options is that they allow us to adapt to various type of market conditions and approach trading in different ways. Classical examples would be directional trading or non-directional, even though there is more than that. But anyway, we're going to spend an hour looking at those market opportunities and learn from it. I highlighted a disclaimer on the upper left side of the screen. I certainly indeed suggest very strongly that you read it carefully, you read it completely, because trading involves risk. There is financial risk involved. It is a serious thing. And we want to make sure that you guys are well prepared from all angles to do your trading properly. But that starts with you guys understanding that this is serious stuff. Okay? Very good. Agenda. We're going to look at the market, get to understand a bit more about the market environment. We'll review trades that we may have running. We'll talk about trade management, if anything needs to be done to those trades. And from there, we'll move into looking for new market opportunities, which is when it gets more interesting, I would say, even though it's all important. Okay. How are you, Clive? Good to see you. Mario, how are you? Very nice. Okay, so just checking all the chats. Everybody's good. So let's go for it. So let's begin with our market analysis. Okay, and here what we can see here is a chart of the S&P 500. Okay, let's begin with the chart on the left. Okay, when looking at the left, we can see that we have a climate at this moment in time. Now, if I zoom in, you may notice that the climate is not confirmed. It's a thin dot. And this, I wanted to bring this to your attention because yesterday I had a confirmed climate, but today is showing us non-confirmed, as you can see. And this has to do with the data feed I am utilizing. I'm utilizing a different data feed. And there must be a problem somewhere in the prior data feed I was using. And that implied that the climate was looking to be confirmed where it seems not to be confirmed. So we will look into that deeper, but definitely something to keep in mind. Indeed, there is a directional component, which is up. The color blue is indeed valid, but as you can see, price movement is so congested in the recent times that indeed the climate is not confirmed at this moment in time. So not sure why yesterday I got this other reading. Again, I believe I was using a different data source. Okay. In any case, when looking at this daily time frame of the S&P, we know there is this directional component to the upside, but we can also see this from the point of view of implied volatility for the calls being greater than the implied volatility for the puts. And it's not like the difference is humongous, but there is a difference. Okay, 12 is the implied volatility for the calls. 11.33 is the implied volatility for the puts as an average during the last 3 days. So in other words, there is some buying intention for the calls or selling intention for the puts or both, which is a bullish thing. This kind of like represents or reinforces the concept that the market is more likely going to move higher than move lower. Even though we need to look at a few more factors that may help this to be the case. And one of the key factors that we can see here on the 55-minute time frame is a green UFO that just formed actually today. That was not there yesterday, but with that movement of price going higher, so that green UFO just showed up, and it signifies, it represents the addition of on-field orders to buy. And those on-field orders to buy being so close to price, if that market was to try to go down, it will likely react to the orders and be pushed back up. So in that sense, we do have a climate that will probably propagate, and in the following days, we may get to see that dot to become thicker, and now we have a confirmed climate. Okay. I want to take a look at as well at what's happening in the options prices. Sorry, in the options volumes. So as you can see here, when looking at options volumes, almost every single expiration date has more calls traded than puts. So we got 1.6 on the front week, more calls than puts by a ratio of 1.6. In this case, more puts than calls for a ratio of 1.2 in the next expiration date. But then again, it's 1.5 and 1.5 in the favor of the calls. We can see that we are above the average on the call, but we're also above the average on the put side, and those numbers are not that great, right? So those numbers are not super intense, which again it's understandable because we are in a market condition where there is a lot of range trading, and therefore there are many buyers and many sellers. There is a little bit of a bias, if you wish, when it comes to the call side, to the bullish side, if you wish. But really, what makes me happier, thinking of seeing the market going higher, it's the fact that the implied volatility for the calls together with the climate are pointing up. Okay, that's really what's key. The options volume at this moment in time, maybe later in the day, will, but at this moment in time, at this time of the day, it's not providing any significant data that kind of gives us a significant edge to do anything in any direction. Okay, so this is what we have when it comes to the market. When we look at the VIX, it's going to be about the same as yesterday. So the VIX yesterday was just a little higher, 17 point something, a bit higher. Today is 17.3. So not a very, very big difference, but it did go a bit lower. And most importantly, a red UFO just showed up, which is likely going to help for the VIX to be pushed lower. And that is relevant because if the VIX goes down, typically what you would see is the market go up. And that is in line with the prior analysis that we have done for the S&P. Okay, so again, this is not an analysis designed to bias us, and now the only thing we do is to buy stocks or things like that. This is an analysis especially to be able to manage your portfolio better. We're gonna analyze all opportunities independently, but taking or not taking this opportunity may depend on what you already have in your account and what the market is likely going to provide. So let's say that in your account you have so many shorting opportunities, and now you see the S&P that is, based on what we said, more likely going to continue moving higher than lower, but everything you got are shorting opportunities. Well, then probably your account is going to suffer a lot, and therefore looking for longs would be a priority. Now, let's say you already have longs in your account. Well, looking for shorts is good to be hedged, but it's not critical given the setup that we can see on the S&P. And also knowing that, normally when the S&P goes up or down, typically the majority of stocks follow. So, all those are thoughts to be kept in mind. And again, everybody, in the group is going to be in a different situation. Some of you may have urgency to take a specific trade in a specific direction. Some of you may not. And again, it depends on what you have in your account already when it comes to open trades. Okay, so that's why I'm making those comments. Okay, so I want to make sure everybody understands, especially the ones of you attending the session today that may be newer to our sessions. I want to make sure you understand that the mindset is never to bias ourselves, and only go long, only go short, because even the best trade in the world, still have probabilities of stopping you out. So in other words, we always need to balance out our portfolios, enter smart trades with odds in our favor, and act on those trades independently. You could actually trade without even looking at the S&P and just assess those trades independently and give it a go or a no-go depending on the rules on your trading plan. Okay, but again, when you think of a portfolio where you have multiple trades running in parallel, so this is where I believe that the comments I just added may be useful to you to know what kind of urgency you have and what kind of trade you need if you have already multiple trades running in your account. Okay, let me take a look at the chat box. Siderman, how are you, my friend? That's exactly what was happening to me yesterday. Siderman, I was using the data feed from TradeStation. Today I'm not, and I'm not sure why TradeStation was giving that data. I've been looking at it intensively, and I don't understand. I believe there is some bad data on the data feed of TradeStation in the past 2 days, based on the research I've done. Okay, so that's why I switched to a different data feed to get more accuracy on the screen. But again, if I know more about this in the following sessions, I will let you know, guys. Okay, this sometimes happens. Okay, I mean, bad ticks or bad data sometimes happens, and it takes very little, sometimes that the high of a candle or the closing price of a candle is in a different location. Next thing you know, when AutoClimate processes market data, you may get a different reading. Okay, so yeah, it's part of trading. Okay, yeah, Christian, I hear you. I hear you. I hear you. Leland, how are you? Leland, good to see you. Good to see you. Very nice. Okay, so now let's get into the trades that we currently have. Okay, so we can review these trades quickly. It's going to be very quick, to be honest. So if we look at SKT, this is a trade that we commented on yesterday. I have absolutely nothing new to comment. I mean, yeah, great news. Is moving 4% in one day up, so that's extremely powerful as a move. But we need that stock to be above 21, before August 21st, August 20, which is the expiration date. So it's still looking like a very unlikely trade, even though we did manage it according to our plan. So nothing else to add. Just nice to see a 4% move, but again, let's not allow ourselves to create any sort of hope. We need to be emotionless and no need to be impressed. Okay. Side on my UFO and percentages are different from yours also. Yeah, definitely. If we're using a different data feed, in this case, I was using top in that case. So definitely it's gonna be different. We can talk about that more in other sessions. And it's not like my percentages are gonna be magic. Okay, we are lining up multiple tools together to validate a trade, isn't it? So I get your point, Cyberman, and we've seen some divergences at times. I am wondering as well if those divergences that we've seen at times may be the reason why. Yesterday when I was using the TradeStation data feed, I had thick dots on the climate where, after the research I've done today, doesn't make sense, and that's why I switched to a different data feed. So not sure what it is, and certainly I will try to do my research to find out why, because it's quite uncomfortable. But at the same time, we don't need to be that perfectionist, in the sense that, and I am, believe me, but in the sense that even some brokers, like let's say you use TradingView, for example, and you get real-time data, but you get it for free. Well, that means that you're only receiving data from one exchange in the US instead of all exchanges. So that means that certain candles may have a different opening price, closing price, high and low. So again, different brokers, different platforms at times, depending on the data feeds, even with centralized products, may give you a little bit of different data. Putting on the side the bad ticks that could happen as well, in all databases. But again, let's focus on the trades. So FSLR, it's the one trade that we put together yesterday. So we entered this trade yesterday to the long side. That stock is dropping by 1% today, so obviously that is not good. If I bring in TOS, you can see this trade is showing a little bit of negative PNL. Okay, so I mean, it's okay. Why am I saying it's okay? Well, because remember the plan yesterday with FSLR. If I go back to what we commented on, so was either, remember, there were two cases. Case number one, you have no trade in your account and you want to enter in a proper way, right? Which is what we always try to do, right? So in that case, I believe we were looking at FSLR. Was it the 55-minute time frame? I believe it was. I believe it was this one, right? Or this one. I forgot the time frame we were using yesterday. Maybe it was the 2-day time frame. I'm not sure. Anyway, it doesn't matter. So what we said yesterday is, if we wait for price to come to the UFO and then you take the trade there, now you have a pretty high chance of this working well, because of all the different parameters that are part of this trade. What was the issue? Well, the issue is that we were far away. Okay, yesterday we were far away from those UFOs. Price was trading up here, and we talked about, okay, what about case number two? Which case number two was, what if you had to enter a trade because you needed for a hedge? And in that sense, we said, okay, so then we're going to use our 8-minute time frame, and what we're going to do is that we're going to look for either a break of a pivot high, or we're going to look for an Elliott wave indication like it happened here. And when that happened, so we gave ourselves permission to get into the trade, and for a while it was moving in our direction. Now it seems to be moving against us, but again, it's not too important, to be honest, because remember, this is an 8-minute time frame. We're just trying to find a little bit of precision for a hedging trade, meaning that you had multiple shorts in your account and you needed a long. So we're just trying to find a little bit of precision for a hedging trade, knowing that it's okay if it moves against you because it means all the other shorts are working your way. Is that making sense? Plus, that stock got the grouping, the climate, all of those things in its favor. So it may take a little bit of time, a little bit extra, but maybe later today, maybe in the middle of next week, it will start moving, or it should, or it's likely going to start moving in the right direction and start picking up profits. Okay, so the fact that the beginning part of this trade is starting with a little bit of negative P&L, it's indeed not concerning. And it's part of trading. And indeed, we're gonna lose precision and in our timing decisions if we drop all the way to an 8-minute time frame. But again, if you need a trade because you need, then there is no option for us to wait for price to retrace back down into a UFO, because it may or it may not. And if you are waiting and waiting and waiting and it doesn't, then you never got your hedge that you need in your portfolio in that assumption. So all of this is kind of a little bit of a review of certain things that we covered yesterday, and hopefully it brings all back to your memory and everybody's with me. And now in my mind, unless you have questions, and if you do, please type them, but in my mind, it would be now time to go ahead and begin looking for new trade opportunities and put them together, just like what we did yesterday with FSLR, but find more. Okay, that's the idea, and go through different setups, everyone with their pros and cons, and see if we validate or we invalidate such setups. Okay, so I'm gonna start. So I'm gonna get my matrix here. Let me float it. So here's the matrix. Okay, and so let's begin. Let's I mean, based on the analysis we have done for the S&P, it looks like, you know, there is a greater probability for the S&P to go higher than lower. So, you know, not everybody got into FSLR yesterday. Maybe some of you have no trade in the account right now. So I think that a good place where to start would be to look for longs first, and then we'll reverse it and we'll look for shorts. Okay. When I say longs, I mean bullish strategies, because, you know, you can be bullish and be short options, right? So what I mean longs, I mean directional moves to the upside. So let's begin with our advanced option scans, looking for a positive differential, a positive continuous implied volatility spread between the call implied volatility and the put implied volatility. And also, because we're going to be directional to the upside, we want to be buyers of options. And when we buy options, we want them to be as cheap as possible. So then we're going to start with looking for a continuous implied volatility on the put side to be less than the 20 percentile. Okay. Why put? Because, you know, we made the first rule was the calls, we want them to be more expensive. So, you know, good enough if we work on the puts to be just a bit cheaper, knowing that the calls are going to be just a bit more expensive. Okay. So by doing so, we end up with this list of stocks. And then I'm going to add stock filtering criteria, both for the stock and the strength, where I want both the stock and the grouping to have strength in the longer term. Okay, now that reduced my list to 4. Okay, and apart from that, I also want to make sure those options are liquid. So I'm going to do this, add my penny increment list. If I scan for it, now my list is only 1. Okay, I also want to make sure I got, you know, room to go when it comes to earnings. So to catch a move, I'm going to give it at least 15 days, okay? Because, you know, it's difficult to reach a target, which is a decent target, in less than 15 days, I would say. And then finally, I'm going to move into my auto climate. And here, I'm going to use the same conditions I had yesterday, which is I want my weekly auto climate to be confirmed up early. Okay, so it's going to be maximum 3 dots on the weekly time frame, maximum 3 dots, where I am okay with the daily to simply be confirmed, you know, and sensible. I don't want it to be hopeful. I don't want it to be late, but I don't necessarily need to be early. I don't need to be that perfectionist. So then I'm just gonna go with sensible and early, and by doing that, I end up with that trade, which is, you know, F5 networks. Okay. So again, later we'll look at other ways to make this list to be longer and play with other option strategies to be able to take advantage of that. But right now I'm just going for an extreme, which is the cheapest options I can with the greatest quality stock setup as possible. That's what I'm looking for at the moment. Okay. And this, of course, when you narrow down so much, it gave me one symbol. So I'm clicking on the symbol, and now we are going to start our market analysis. Okay. Let me take a look at Mario Jose. By using the CIV put less than 20, we are not scanning for more or less cheap calls. No, but again, it's okay because again, if I do it, it would be better. I'm with you, Mario. But if I do it, I'm gonna shorten my list even more. I mean, in this case, we only have one, so I'm not sure what's gonna happen if I use the call to be less than 20, but I may end up with nothing at all. Okay. In this case, the calls are also very cheap. Great. It's great to see. But my point is that we don't need the calls to be that cheap because we're gonna be doing spreads. So if you were to just buy a call, then yes, of course, you want it to be extremely crazily cheap, because when you pay for a call, the most you can lose is what you pay for it. So, and there is no offset, and time decay works against you, and there is no offset on Vega either. But with a spread, we can offset a lot of the things. So even if I was to buy calls that are a bit more pricier, okay, which let's say instead of under 20, they are between 20 and 40, right? And so the calls are not so cheap, right? Still okay, because in a spread you buy a call and you sell a call. So you buy one which is expensive, but you also sell one which is expensive, and therefore it will kind of balance out, this tiny problem. Then you can adjust the strikes in ways where you can also balance out very much the Vega exposure, and then we're gonna be fine. So we don't need to look for the calls to be under 20. Today it didn't make any difference, but there will be other times where you may have 10 symbols, and when you shoot for the call, your 10 symbols may end up being 2, and it's just because you just want the call to be so cheap, which again makes sense, but you don't need to, because you are planning to do a spread, and therefore you're gonna offset that expensiveness that is in the call a little bit. Okay, it's still more. I mean, what's most important of all is to be right on direction when you do a directional trade. That's what's most important of all. If the trade goes against you, that you lose. Even if the option strategy was set up amazingly well, you will lose if the stock goes against you, because you are positive delta, and if it goes against you, that's gonna kill you, right? So I am very, very happy to have this here, because that's gonna give me an additional odd in my favor for the stock to move higher. But the downside of using that particular condition is that it would always make my call to be a bit more expensive. Always. Okay, so that's the price to pay. That's the trade-off. So you will have more probabilities on being right, directionally speaking, but then your call will be a bit more expensive. How do we offset that? We'll adjust the spread with certain parameters, so the Vega is never too great, and then it's never too much of a problem. But in this case, we do not need also to check for the cheap put. Well, my assumption here, if I go for the cheap put, okay, so if I go for put under 20, so my assumption is if the put is under 20, the call may be under 20 or maybe slightly above 20, right? To be honest, you can also go ahead and look for the mean, right, which is the midpoint between the call and the put, to be under 20. And all of this is going to make a very tiny difference, but I'm trying to maximize my list of items, and therefore the one that will benefit me the most to having a larger list is going to be put less than 20, because everything, because again, I'm going to be able to work with my spread to adjust it in a way where my Vega exposure will not be a problem. So I'm trying to give priority to maximizing the length of this list, and then by selecting put, that's how would you do it. This is how you would do it. So this is the rationale behind what I'm thinking, Mario. I get your point, 100%. Okay, but again, we will adjust the spread, so it's fine to be a bit tolerant here. And you know me well. I'm super demanding and strict and perfectionist. But in this case, it's we don't need to have calls less than 20. Okay, with put is good enough. Don't you mean positive theta? No, we're gonna do a spread, and it's gonna be negative theta because it's gonna be a debit spread, Siderman. We're gonna be buyers of a spread, so that's gonna be debit. Yeah, great questions, Mario. I appreciate that. These conversations are the conversations that we need to have. Okay, these are the conversations we need to have. So you guys keep asking your questions, because this is how you guys will master this. Okay. So anyway, so let's take a look at that stock. Okay, so we are looking at FFIV. And as we look at the stock, so we can see on the daily time frame that stock is showing 12 out of 14, so it's indeed sensible. So the matrix give us that reading. And now the one thing that is not providing too much of an edge is the implied volatility of the calls and the puts. It's actually showing the same value. Okay, so how come on the matrix it show greater and then here it shows equal? Well, because here I'm doing the 3-day average. Okay, and again, in a perfect world, I would want to see the average to be greater. Okay, now what I don't want to see is to have the average to be less. Okay, in this case is equal. It's not the most ideal scenario, but I would certainly take it, because if I move that 3-day average, if I was to edit that study and I was to remove the 3-day average for the calls here, right? So if I uncheck the smoothing, right, and I apply it, right, so now you will see, okay, unless things just have changed while we were doing it. Well, I guess that things just changed as we're doing it, or maybe it's a matter of decimal perfection. But again, it should be, I mean, if the matrix says it, I'll take it. So there should be a little bit more implied volatility on the calls than the puts. In this case, it seems as it's just a matter of the third or the fourth decimal place, which we're not charting. Okay, so that's why it looks like equal. But it doesn't matter. It's good enough. Okay, so we have the climate, we have the whole thing, so it's all good. So the key now is, we know that 206.27, okay, 206.27 is our reference value, which is the value of the EMA. So in a perfect world, for a perfect trade, you want that stock to come to the black line, and when it comes to the black line, you take the trade from there, expecting it to go back higher. Now, for this to happen, you need UFOs around 206. Okay, so do we have UFOs around 206? Well, by using the 2-day time frame, indeed, a beautiful UFO there is waiting, for the trade. If that market comes to the UFO from there, very likely going to higher. And certainly that will be a good trade for us to plan on. But I also want to look at different time frames, okay? And why do I want to look at different time frames? And by the way, you may say, wait a minute, Jose, you are looking at the daily time frame, and here you're looking at the 2-day time frame. How can that be? You're making a mistake, Jose. You need to go to the 55-minute time frame. Okay, so as you know, in the past few weeks, I have been changing a few things. More than changing, really, I've been adding a few more combinations of rules that make sense and that still give us odds of success now, because we have tools that are more powerful to do scanning and to plan the trades faster, so we can go through more setups and execute more trades more easily. And therefore, that implies also an impact on a series of rules. And if you recall, the way we used to do certain things, we would always look at the daily here for the climate and the 55-minute time frame for our UFOs, and then we will look for a UFO lining up with a 206, which, by the way, we have one there. Okay, and now you would wait for price to come here and take the trade, even though this trade would not be accepted because probabilities are less than 50. So we would say, not a high probability setup, we pass. Okay, one last choice we will give the trade is to look at pre and post market, which also provide UFOs. Probability is 42%, is also under 50, and therefore, based on the rules that we have been using for a while, we will just not take it. Okay, now what is it that I'm going to add as a new rule and therefore a change? Well, I am going to approve any trade where we have UFOs, no matter the time frame. So, for example, the daily time frame of FFIV shows 53%, which is more than 15, and has a UFO between 207 and 199, which coincide with the black line. So we can take it from there. We can also take it from the 2-day chart, which also has a UFO with 50% or more. We can also take it, well, not from this one. The 3-day chart has 60%, but no UFO, around 206. So why is it that I'm going to allow to use any time frame, including time frames greater than the climate time frame? Why is that? Well, the reason why is because this is not a stock trade. It's an options trade. So if I was to take a stock trade and I was to use, let me go back to the 55-minute time frame. I was to use an entry, stop, and target, and this was to be my entry, and this was to be my stop, then I would welcome very much the UFO on the 55-minute time frame, because being such a low time frame, minimizes the distance between my entry and my stop. Okay, helps me maximize the position size if I was to trade stock shares. And therefore, if I'm wrong, I'm going to lose less. And if I'm right, I'm going to make more. And my target is going to be further away based on a daily time frame in this case. And therefore, all of this would imply a greater reward to risk ratio thanks to a UFO from a lower time frame. Okay, so it makes million% sense. And if you trade shares of stock, I would suggest that this is the way to do it. But because we're trading options, and what I'm going to do here is a bull call spread, for example, and that's a debit strategy, meaning that when you pay, let's say, $500 for a debit strategy, the most you can lose is 500, no matter where your stop would be if you were to use stops. So then that opens the door. I don't need those UFOs to be narrow. I just need a UFO to be present because the UFO represents a high probability of turning point. So I just need a UFO to be present, but I don't need it to be narrow. So now I can go ahead and rely on other time frames, no matter the time frame. Like the daily time frame has such a fat UFO from 207 to 199. This is like $8 or $9 UFO. This is very wide. But you know what? It doesn't matter, right? Because if it goes against me, remember we are running a portfolio, right? So you have multiple longs, multiple shorts. So if price comes here and doesn't bounce, it keeps going lower. So now probably those guys are gonna turn this around, and not immediately, but later in time, you may be back in business. While in the meantime, you took some profits from short trades that you had in your portfolio as a portfolio manager. So we are not, because we're using options and our debit strategies got limited risk, no matter what, we are not gonna set stops. Okay. Also, stops are the recipe to get extremely problematic slippage unless you are trading extremely liquid stocks, which now would limit you on how many trades you can take, because we are filtering based on grouping, on this, on that. So if on top of that you need those options to be the most liquid in the world, so then next thing you know, it's going to be rare to find a valid trade. So then if that was the approach, I would say just trade stocks. It's a much better way to do it, right? And if you're outside of the US, just trade CFDs. And that's it, right? Done. But if you're going to be trading options, you have so many other benefits. And one of them is now that you can be a bit more flexible with the timing of the trades. And therefore, now we're going to be a bit more creative with the time frames. As you know, and I didn't talk about this before because TradeStation doesn't allow to do 2-day time frames or 3-day time frames. But now we have a tool where we can do it. And therefore, you're gonna see more flexibility on my end when it comes to both the time frames that I use for entry as well as the climates. Okay, as well as the climates. So I'm gonna plan this trade. Okay, but before I wanna say one last thing. So let's say I got nothing in the list. Okay, let's say I got nothing in the list. I could go ahead and say, okay, what about if the climate is a 2-day climate and I rescan, and in this case I got nothing. But what if now I got an option here? So then I would come back here, and on my climate chart, I would now move it to 2-day. Okay, and then do the same assessment with a larger time frame. Okay, and again, I would move to the right to see my UFOs, and I would not mind which time frame is the time frame that gives me a UFO, as long as the UFO is lining up with the new reference value, which is the black line, the black EMA. Okay, so again, you're gonna see me be more flexible, and I believe that at the beginning, I may confuse you a bit, but I guess it's like everything in life, it's a matter of practice and repetition. So we do it together. You guys ask questions if I do confuse you, and I will clarify, and you will see in not too long you're gonna be very comfortable, and we're gonna have more trades, and it's gonna take less time, and they're gonna be of a higher quality too, because the UFO performance on the 2-day time frames and 3-day time frames are normally more efficient than in the 55-minute time frame, isn't it? So so all of this is good, even though I had to spend a bit of time to explain the various things that I'm going to do differently. Could you guys please give me some confirmation? Could you guys please type on the chat box and just let me know that you are with me. I am indeed happy to repeat it if you need me to, but I just need to know that you are with me. Okay. Okay. So now, we're gonna be planning on a trade with a stock. Okay. By the way, talking about differences between TradeStation and data feeds and all of that. So if you look at TradeStation UFOs, okay, the way the labels work, and you know these by heart, I'm sure. The way the labels work is that the price that you see represents the inner circle, and the next price you see represents the bottom part of the UFO band. That's what we have on TradeStation. It's not like that on Thinkorswim. Sorry, not Thinkorswim. On TradingView, and it's not like that on MetaTrader either, which are all the platforms that we have. So guess what? It's not like that in top either. So the values that we have on top are the very top of the band and the very bottom of the band. So if you want to know more about the inner circle, you just put your mouse there and you would see the price. But it's not like in TradeStation where I used to click and hold the band to find out what is the upper price. Now I can just read it from here directly. Okay, so that saves a bit of time as well. So 207.84 would be a valid entry price. If that stock was to come here, we would now construct a trade and write the move. The other possibility is, what if you need a trade now and you need it now because you need it now because you have short trades in your account and you need some hedge. So then again, knowing that the trade is there, so you can use the 8-minute time frame. Sorry, so you just need the 8-minute time frame to plan on the trade. And by the way, it's actually time to enter right now, because we got an Elliott wave turning point, and the next candle is trading above the candle where the Elliott wave turning point took place. So it's actually time to enter now, exactly right now. Okay, so I'm just gonna put the trade together so we can again go through the process on how to plan it. I only have one thing that I need to do, which is I need to identify the target, because we need a target date. Okay, so when looking at the daily time frame of that stock, okay, I guess it's pretty clear that this is the very the reference, which is the key, right? So what I'm going to do is I'm going to click on the very top, and that's going to project where my target would be, and I'm going to go for the middle box there, which is, let's call it 232. Okay, so that's going to be my target at 232. That's where I'm going. Okay, so we are going to plan this trade thinking we're going to 232. That's what we're doing. So with that in mind, the first thing we need is, do I have the strategy builder there? Yes. So with that in mind, the first thing that we need is to find out how long it's going to take to reach 232. Okay, so I just type 232 just so I get the target date value, okay, which is 9/13. So reaching that target, okay, would imply X amount of time all the way to September 13. So what is the earnings date? So I got the earning date here. Okay, if I scroll to there, here we go. That blue box is the earnings date, which happens to be October 25. So 9/13 is my target date, but we're going to use October something as the expiration date to be used, because we want to line it up as much as we can with the next earnings date. So knowing that, we are now going to go to our spread builder. Okay, and with the spread builder in mind, again, we know our target is 232. Our target date is going to be, actually I need to use the expiration date first, which is going to be October 15. That's what's available. I got September 24 or January 21st. So October 15 is the one, is the nearest to the earnings report. And August 13 is the estimation for the target date. Okay, so we've got that. So now what? Let me maximize it. And now we're going to start working on the various different components. So the price of the stock currently is 212. The target is 232. So the minimum range we're going to use is $5, because if you look at we didn't look at the option chain, we don't need to, but if you were to check the option chain, you would see strike price increments of $5 at a time. That's the minimum, and this shows automatically here, so that's why we know. But then for the max range, which if you recall from yesterday, max range means the difference between strikes. So we need at least 20, right? Because the difference between entry and target is 20, so we need at least 20. But again, computer can do a lot of work for us automatically, so I'm just gonna be generous and just type 50 and get the computer to build many options trades. So we're gonna get to analyze that. Now, while the computer built all of these for us automatically, which is great, and I can even build more by adding more here, number of strikes, 1, 2, 3, so I can add more strategies to be built. Of course, I don't care about all those strategies, and indeed I don't want to review them all manually. That would be crazy. So what I want to do is I want to filter them. So I'm going to use an options filter, and I want to filter them based on certain parameters. Okay. So first of all, this is a debit strategy. So indeed, we care very much about the location for the ideal strike zone. We want, okay, and I don't think I need to re-explain that. Yes, Joe, you're right. Earnings is on October 25. We don't have any expiration which is lining up with 25. The nearest one is October 15. So we'll take that. It's the best we can do. The next one goes all the way to January, which may coincide with the next earning report. So then it would indeed not help and make the trade way more expensive. Okay, way more expensive. Let me see. There are more comments there that I missed. Sorry for that. Yes, Mario, all great. For interest, tradestation 55 is 50%. Yeah, fine. Again, I'm using a different data feed. Plus, I got loaded 500 bars on my 55-minute time from here. So probably you're using 1,500 something. So all of those are the reasons for the differences. But again, I'm going to be much more pragmatic. Okay, before, because I didn't have any other choice with TradeStation, if I didn't get the probability I needed, I would then move to the pre-post market and cross my fingers, and hopefully I would. Now, if I don't get it on the 55, I'm just gonna go for the 1 day, 2 day, 3 day chart, and I know for sure almost always I get the probability I need. So I'm just gonna be that pragmatic. So I don't even need to load that many candles on my chart anymore. Okay. Again, I get your point, and definitely that's valid information, and I appreciate you sharing, especially in a transition period, if you wish, where I am incorporating new tools to the sessions as well. Okay. Yeah. Thank you for that, Mario. Thank you so much. So anyway, so we're talking about the spread that we're building. We build so many spreads, okay, but we want to filter them out. We only want the ones that are best. So the ones that are best are going to be the ones where the option that we buy is going to be within the strike zone, okay, within the ideal strike zone. Okay, if it's not within, that's a problem. So I'm just going to go for full. Other things I will care about when it comes to the options I sell is that the options I sell are going to be outside the ideal strike zone. So the opposite. Okay. I will also care about, getting paid at least 35 cents for the ones I sell. So I'm looking at a bid of at least 35. Okay. Everything else below, I will certainly use it, but it's gonna be useful for non-directional trades, not for directional. So far I will leave it unchecked. And then of course now we need to talk about the spread. Okay, where we want the delta to be between 25 to 45. Okay, it would be great as well to have a positive gamma. I'll do it like that, 001, positive gamma minimum at entry, as well as a positive gamma 0.0001 at target. Okay, so the gamma remains positive all the time. And now here, Mario, you will see how I'm going to adjust the Vega. So I will want my Vega to be contained between negative 0.25 to positive 0.75, meaning the Vega will not be that great. So even if I bought calls that were a bit expensive, because I'm selling calls that are also expensive, and I keep my Vegas under control this way, so then the impact of the call being just a bit more expensive is not going to be that problematic. Okay, I'll come back to this in a minute. Okay, to look at return on investment. Also, I want to save this as template, so I'm going to show you that in a moment. I will uncheck as well. This is an extra filter for the ones of you that may only trade only very basic option strategies like long call, long put, pull call spread, bear pull spread, things like that. We trade everything, so I'm just gonna uncheck it so we can filter everything instead of be limited on what we filter. Okay, so I will just uncheck it, and then we're just gonna click OK. So when I click OK now, I got my option spread filter column that just showed up, and I'm just gonna sort it. And now notice that out of everything I built, I got 5 of those trades that pass. Okay, 5 of those trades pass, and the rest don't. Now, let me see what's happening here. Because we got the delta we want, we got the gamma we want, we got the Vega we want, we got everything we want, all is good. We are buying the 210, 230, 210, 230. Okay, got it. Yeah, I'm just reconfirming everything. So all is good. Okay, but here I see something a bit strange, which is the P&Ls are negative. Okay, so it seems that if I reach that target, those targets, or even if I reach my target on the expiration date, I am losing money, which is complete nonsense. Okay, so that may mean that the last update I just installed on top may have a little bug there, which I thought was corrected, because I got this problem yesterday and I thought it was corrected. So I'm very sorry about that. So let me do this. I'm gonna bring top number 2. Sorry for that, guys. I mean, we started with all those sessions a bit sooner than what I would normally have done. Okay, but with the summer break and so on, and some of you were going to be on vacation and all of that, so I was kind of motivated and convinced to start with the sessions before we release the platform officially, and therefore, so you get to see some little issues. Okay, great. So now I'm trying to connect. This is Murphy's law. So I'm trying to connect to TradeStation. Well, that it's very appreciated, Maka, that you have this positive comment. To be honest, I'm not very happy this is happening, because it's consuming a lot of the time, and we but anyway, I really appreciate that. Okay, very appreciate that. So anyway, Murphy's law, as I was saying, this is funny. So I am launching top for TradeStation, and guess what? It's using TradeStation data feed, and guess what? TradeStation is having an update, and therefore I am updating TradeStation in the background in my other computer screen. So it's let's laugh a little bit. So I'll have a sip of water if you don't mind, guys. Hopefully this goes quick. Yeah, so TradeStation is being updated. Come on, Mr. TradeStation, do this quick. We're waiting for you. So out of curiosity, I'll share, since we are in a little bit of a waiting mode here. So for the TradeStation version of top, right? So because we got 2 versions of top, the one that works with a market data provider only, no broker connection, but also the one that connects to TradeStation, which is a broker, so you can trade using top, not only analyze the market, but also trade. So with the one with TradeStation, it does require to have TradeStation installed in your computer. It doesn't require that you run TradeStation on top in parallel. That's not required, but it does require that TradeStation is installed in your machine to be able to get to do the user validation in the TradeStation network, to be able to get the data and send the orders via top, but through TradeStation. Okay, so I believe the TradeStation updated is completed. So I believe I am about to be able to launch top for TradeStation, and look at it there, because again, as I said before, we are doing the final tweaks before we release top to the public, and among those final tweaks are some additional functionalities and things, and here we go. So here is top for TradeStation loading, and we're gonna have it on the screen in just a moment. So yeah, so I don't have exactly the same build, the same version of top with TradeStation that with the other data provider. Here we go. Cool. So let's load the spread. Okay, the spread builder with TradeStation. Okay. That was FFIV 232. So I'm gonna move this guy. So I'm running 2 tops right now at the same time, which is cool. So this is the one from TradeStation. Okay, so I'm gonna do the same thing. I'm just gonna float it, and I'm gonna do FFIV, and we said we were going to use a bull call spread, and we said we were going to look at October 15 expiration, not multiple, only October 15. Yep. We said we were going to set the date to be September 13, and the target being 232. And we set the range from 5 to 50. I believe we did that. And then I just added the filters, which were full ideal strike zone for the options we buy. For the ones we sell outside, minimum 35. And then we said for the next net spread, I want delta, gamma, and vega. And we said I want 0.0001, 0.0001, and then we said not to check this filter because we trade everything, so we want to filter everything we trade. So okay, so hopefully this time we're gonna be okay. Okay, so I'm having the same issue, guys. So so I apologize for this, and this is obviously a problem because I installed a new update of top today based on the final developments we're doing, and I guess we messed up with something that is not calculating the P&Ls correctly. I guess it's funny because the ones that fail give me positive P&Ls, the one that pass give me negative P&L, which is the complete opposite of what it should be. Yeah. I'm just reading your comments. I thought it was October 15. I got October 15. Yes, I got that. Siderman, could you please restate the rule for the bull call spread? Yes, I could restate it, even though unfortunately I'm not going to be able to use it. Okay, so because I got an issue on the platform at the moment. Okay, but anyway, the rules were this. And by the way, so what we're going to do is that I will save this as a template. I will do it for all the strategies that we trade. So next time, like for example, let's say this is exactly what I want. Okay, so you may add return on investment, maximum risk. So you want, minimum 50% performance. You want risk minimum $50 per trade, and you want to risk maybe maximum, $750 per trade. So let's say that's you. So then you would save that as a template, and you would give it a name. Okay, and this could be, again, I'll have these ready for you guys. Okay, so bull call spread. So bull call spread parameters. Okay, something like that. So now when you save it, okay, you will have bull call spread parameters, bear put spread parameters, iron condor parameters, whatever. So every time you load that, okay, so here is gonna tell you what is it that you're filtering for, bull call spread parameters, okay? And then if you load another filter, you would come here and you would say load template, and then it's gonna load, whatever other filter you have here, which at the moment this is kind of like it's this folder doesn't have everything that I will have ready for you guys and I will share. So in this sense, you don't need to memorize or kind of make a note of these parameters, even though certainly you can take a screenshot if you want to study and read it carefully, and maybe you have questions for me next time, or you want to shoot an email, for sure you can do that, Siderman. But basically what we're doing here is very simple, even though unfortunately I cannot simulate it, but what we're doing is very simple, which is we are making sure the options we buy have a very high probability of at least breaking even. We are making sure the options we sell have the complete complete opposite probability, meaning that we're gonna take that credit, offset the cost of the option we buy, but probably not have that short strike to hurt too much. And on top of that, we are setting a minimum premium to be collected. And on top of that, with the Greeks, especially with gamma positive, we're making sure the short unit doesn't hurt the PNL and the evolution of the PNL. With the Vega, we are making sure that if the options were not that cheap and they were a little bit pricey, it's not gonna hurt too much the PNL if implied volatility was to drop. And with the Delta, we make sure that the speed at which we profit is gonna be adequate, right? And then risk and reward, I guess this is self-explanatory. Okay, it's depending on your account size. Maybe you want to risk less than 250, so you just type 250. And then it will only pass if the spread is cheaper than 250. And then for the rate of return, it's also whatever it's in your trading plan, right? So 50% for a directional trade, maybe a good starting point, even though it could be anything you choose. Okay, so again, I feel absolutely terrible that I cannot complete this trade because now we cannot do the comparison. Okay, but the final step, we did it yesterday, by the way, isn't it? So the final step would be to look at the P&L, or the rate of return at target on the target date compared to at target on the expiration date, okay, and look for an improvement. So for example, let's say this was ours, okay. So if you reach the target on time, you make 8%. If you reach the target late, you make more. So that's ideally, this is what we're looking for. That will not always be available, but this is what you're looking for, meaning that if you're right on direction and it goes at the speed of the light and hits your target at the speed of the light, well, you'll make a bit less, but fantastic. Just close the trade. Is still a great profit. And now, you free up that capital from being used in your account, and now, you take another trade. Okay. But if, worst case, you were to reach your target more slowly than expected, but then instead of suffering the time decay, then the spread is constructed in a way where you end up making a bit more. Okay. So this is kind of like the setup that we are looking for, and this is the type of trade that we'll find and plan. But as said, at this moment in time, so yeah, I have a problem with the last version that I installed just a few hours ago, earlier in the day, and I never went to check this because yeah. Anyway, sorry for that. Anyway, Mario, the Vega. Okay, so for me to talk about Vega, I need to talk about implied volatility, right? So take a look at this. So let's say you are looking at this particular trade. Okay, so this particular trade, well, this is the S&P. Let me load FFIV. So this is FFIV. So what's happening to that stock? Implied volatility is 24, which is very low. So what do you know about implied volatility? Okay, well, what we know is that typically it tends to revert back to the mean. So if this is the top and this is the bottom, and this is somewhere around the mean, so probably implied volatility will rise and go higher. And if that happens, from let's say 25 to 30, so that's 5% increase on IV, and that's gonna pay you times Vega. So if your Vega, okay, so let's say your Vega is 1.1, so you would make 1.1 times 5, okay, and that would be the increase, okay, 10.5, 0.05, okay, that should be the right amount because it's a percentage. So that would be the increase of value of your options contract. Basically, it would gain some value because implied volatility rallies, okay. Now, what if implied volatility drops, right? Well, if implied volatility drops, instead of rallying, instead of profiting, because the move of the stock is not 5%, but let's say it's minus 5%, so then you're gonna lose that amount instead of profit that amount. So in other words, when you are entering a trade at an extreme low of volatility, you are happy to take this risk because it's so much more likely when you get that low that volatility will go back up, that it's worth it to take that risk, okay? But the scenario we were discussing before is, so the puts are under the 20 percentile, but what if the calls are higher? Well, if the calls are higher, it's still likely that they will go back to the mean, but now you still have a possibility where the calls may go back down, and if they go back down, it's a problem, right? So how do you offset that problem? Well, the perfect way to offset the problem is to have a trade with Vega being 0. If your Vega is 0, it means that it doesn't matter if the volatility goes up or down, because the multiplier effect times 0 will neutralize whatever changes on implied volatility take place during the life of the trade. So now Vega 0 is a utopia, okay? Plus Vega changes through time. So it's not going to be constant. So the idea here is to be flexible, but demanding at the same time. Therefore, in the filter, I had set up a range where I said, okay, a little negative, I'll take it. Positive, I'll take it too. Okay, but not that positive, because if it's that positive, then it may become a problem. Okay, and that's how I came up with those two values, minus 0.25 and plus 0.75, which, by the way, minus 0.25 is never going to be the case in a debit strategy, unless there is a huge difference of implied volatility between one strike and another one, which sometimes happen, but is rare. Okay, when you look at the skew, okay. So for example, here you can see that the implied volatility for the 200 call that expires in August 20, that implied volatility is about 30%. Where, if you were to trade the 215 call, with the same expiration date got 25% volatility. So there is a skew. Okay, that's what is known as the volatility smile. Sometimes it's a little bit, sometimes it's huge. And when it's huge, you may end up with negative vega. Okay, but not always. Okay, most of the times you will. Okay. So anyway, so with the filter, we are just basically getting rid of the bad picks and just sticking with the better picks. So then we can execute a trade which has the greatest odds as possible built in, and then of course now we depend on the market to do the right thing for us. Okay. So I'm just noticing that we just reached the top of the hour. It's incredible how time goes. Mario, did I answer your question? Would you mind to confirm this, please? Thank you. Very good. Thank you. Fantastic. Thanks. Cool. Okay. So anyway, I will close the spread select here. Terribly sorry. I feel really terrible, guys, about what just happened. But anyway, before we go, very quick, so we can progress a bit faster next week, because next week I want to do more directional trades and quicker, but also I want to start getting into non-directional trades. Okay, and therefore I want to bring in the matrix. And one of the things I would like to comment on is I would like to comment what type of filtering we're going to use to do non-directional trades. Okay, and that way I will review next week, but I don't need to explain too much next week. So when we do non-directional trades, we will not care at all about the grouping of the stocks. Okay, we will indeed care about liquid options, so we'll still use our penny increment stock list. We will indeed care about earnings not happening soon. Okay, so we will also exclude companies that are having earnings too soon. And when it comes to AutoClimate is a tool for directional trading, so we will discard it as well. And therefore, the key for non-directional trades is going to be under the strength levels. Okay, so here we got a check mark for daily neutral zone, and here we got a check mark for weekly neutral zone. So this is what we're going to filter for. We're going to filter for stocks that got neutral strength in the weekly time frame, as well as neutral strength in the daily time frame. And the meaning of strength means not only the directional component, but whatever is in there, how strong it is. Is it impulsive? Is it correcting? Is it just sideways? What is it? Okay, so this is what we're gonna scan for, and we're gonna scan for, when looking at options with higher values. Okay, so now we're gonna look for implied volatility mean to be greater than 80. Okay, and one stock that shows up is XLNX. Okay, that could be a valid candidate. We will also scan based on, continuous implied volatility compared to historic volatility to be above 2 standard deviation, which gives us also CRM. So right now, real time as we speak, we got 2 choices. Okay, and again, the way to build those trades would be to come here to the daily time frame. Okay, be very well aware of the earnings date. Okay, which is August 25. Make sure that we're going to use the expiration date before, which is this vertical line, which is August 20. And with that expiration date in mind, okay, which is August 20, so we're going to be looking at, those cones, right, which the blue color ones represent historic volatility, 1 month, 2 months, 3 months, and the red one represents implied volatility real time. So what we're going to do is that we're going to draw a line above and below coinciding with this date. Okay, and that's going to be our statistical range where the stock is supposed to stay from now until August 20. Once we have done that, then we'll do what we're used to do, which is to go back to this 55-minute time frame and look for UFOs, okay, and try to find a setup that allows for a trade, okay, which in the case of CRM at the moment, I don't see any red UFOs, so I don't think that would be the case. But so this is going to be kind of like the process. So we're going to be looking at the matrix with different parameters. Then we're going to start using these volatility cones to plan the trade, but also during the life of the trade for trade management, as you will see. And then, we will bring all of it again to the spread select, and we're going to build our iron condors by selecting spread type to be short iron condors. Okay. And again, we're going to be playing with the filters and the strikes and the ranges and all of that. And again, at the speed of the light, we're going to be able to evaluate the iron condors. And you probably remember that we used to spend so much time looking at strikes and is it liquid? It's not liquid. It's premium enough. It's 15%. It's not 15%. So now we're going to be able to do that fairly quickly. Okay. But yeah, so I just wanted to give you kind of like the big picture framework of the process that we're going to also run when doing non-directional trading. Even though, of course, for that, I first need to do a few directional trades to have everything on the spread select and the filters understood. And from there, now we can move into non-directional. So I'm counting on doing that next week and almost get back to normal speed of usage with top next week, I would say. Hopefully touching wood as well next week or maybe the week after, it's going to be our official release. So hopefully everything is fine and good. And now we spend already a few weeks with a mix of trading and lecture time, both about options and the platform. So I am eager to pick up speed in the next week sessions and find many more trades and so on. Okay. So yeah, I will let you go now, guys. Thank you so much for joining me as always. You guys know this is that very special moment of the week where we spend some time together. It's very enjoyable for me and yeah, and I really love it. So thank you so much for joining me, especially in the past few weeks. With adding top and so on is extra exciting, but also you had to be extra patient. So I really appreciate your patience and support. So see you next week, my friends. You guys keep up the good work and anything you guys know, I am one email away. And by the way, Clive, I don't know if you read it, but I did respond to your email. You guys take care, everybody. See you next week. Take care. Bye-bye.